When I look at today's headlines, job losses, labor slowdown, market panic, I see something entirely different. I see transition. I see the early chapters of a massive economic rewrite that history will later call a reawakening. The world is changing faster than most realize, and with it, the foundations we've long trusted are starting to shake. For decades, people believed that one dominant currency would remain the anchor of global stability, that it would protect wealth, preserve purchasing power, and remain the safest bet in uncertain times. But history tells a different story. Every great economic cycle eventually reaches a point where trust in a single system becomes its greatest vulnerability. And we are there again. The over-reliance on one currency has created an illusion of control. It's easy, it's convenient, and it feels safe until the cycle shifts. When governments expand balance sheets to record levels, when debt grows faster than productivity, and when monetary policy becomes a political instrument rather than a stabilizing one, that so-called safety net starts to fray. You may not see it in a single day or a single headline, but underneath the surface, the global financial architecture is being rewritten. Currencies reflect confidence, and confidence is fragile. It doesn't disappear all at once. It erodes gradually, then suddenly. When investors, institutions, and even nations begin to diversify away from a single reserve asset, it's not rebellion, it's rational adaptation. It's what happens when the cost of faith becomes higher than the cost of change. That's the inflection point we are now approaching. For years, easy money created a false sense of strength. Debt became growth, liquidity became prosperity, and policy became performance. But those dynamics don't hold forever. The world is starting to price risk differently, not just in equities or bonds, but in the very trust that underpins our financial system. Innovation, decentralization, and digital assets are rising not because of speculation alone, but because the market is seeking alternatives, real, transparent, borderless forms of value. We are moving into an era where power will no longer be concentrated in one currency, one system, or one institution. The decentralization of money mirrors the decentralization of technology, communication, and even governance. When people can transact across continents in seconds, store value in digital form, and access financial systems without intermediaries, the monopoly of one currency begins to fade naturally. It's not defiance, it's evolution. And evolution always comes with discomfort. Transitioning from a single global monetary anchor to a multi-currency, multi-asset world won't be linear or painless. There will be volatility, confusion, and resistance. But long-term thinkers know that disruption creates resilience. Diversification across assets, geographies, and systems is not fear, it's foresight. The greatest risk today isn't market volatility, it's complacency. It's assuming that what worked for the last 50 years will continue for the next 50. History has shown that empires fall not because of external threats, but because they overestimate their own permanence. The same applies to currencies. When debt outpaces growth and policy replaces productivity, confidence begins to leak quietly. You can't print trust. The future won't belong to one dominant currency, it will belong to those who understand the interplay between technology, transparency, and trust. The rise of digital assets, tokenized economies, and algorithmic systems of value transfer isn't a fad. It's the foundation of a new monetary era, one where individuals have more control, where value moves at the speed of innovation, and where trust is built into code, not dictated by decree. So when people say, "The system has always worked," I remind them, until it doesn't. And when it doesn't, those who diversified early, those who saw the signs before the crowd, are the ones who not only preserve wealth, but multiply it. The question isn't whether the world will change, it's whether we'll adapt before the change forces our hand. The next decade will reward independence of thought. It will reward those who understand that currencies are not guarantees. They are agreements, and agreements shift with confidence. As inflation cycles, geopolitical shifts, and debt ceilings test global stability, relying on one monetary system becomes less of a strategy and more of a gamble. This is not a call for panic, it's a call for perspective. The world is evolving toward diversification. in technology, in finance, in opportunity. The same principle applies to money itself. The future won't be built on one currency, one economy, or one idea. It will be built on innovation, adaptability, and the freedom to choose better systems as they emerge. That is where resilience lies, not in clinging to what once worked, but in embracing what's next. And those who understand this shift today will lead tomorrow. Not because they feared change, but because they saw through the illusion of permanence and positioned themselves for the reality of transformation. In moments of uncertainty, when markets tremble and confidence fades, people begin to remember what's real. Not the numbers on a screen or the abstract promises of paper value, but assets that hold purpose, function, and truth. Real things. Things that exist beyond speculation, beyond algorithms, beyond the illusion of endless liquidity. In every cycle of expansion and contraction, the world eventually rediscovers this truth. What endures is what you can touch, use, and understand. For years, investors have been conditioned to chase digital signals, earnings projections, financial models, central bank policies. But when the foundation of those signals starts to shake, when inflation eats away at purchasing power, and when confidence in systems wavers, capital naturally migrates back to the tangible. The world is waking up to that transition again. Real things are not just commodities. They're the backbone of civilization: energy, land, technology, infrastructure, intellectual property, and productive innovation. They are the engines that generate real value in a world overrun by derivatives of derivatives. When liquidity is abundant, owning what's real feels old-fashioned. But when liquidity dries up, it becomes essential. Tangibility anchors value. It brings gravity to a system floating on promises. And as we enter a new era, one defined by technological acceleration, monetary experimentation, and geopolitical tension, the divide between paper wealth and real wealth is widening. Owning real things means owning the future's foundation, the energy that powers artificial intelligence, the metals that enable electrification, the data networks that connect the world. These are not trends, they are necessities. They're what the next economy will be built upon. While financial markets often reward short-term narratives, history rewards those who position themselves in assets that sustain civilization through every transition. Innovation doesn't eliminate the need for the tangible, it enhances it. Every digital breakthrough, every autonomous system, every new frontier in artificial intelligence requires physical infrastructure, real inputs, real energy, real materials. You can't build a digital world without a physical backbone. The irony is that the more digital our lives become, the more valuable tangible assets become in scarcity. There's a rhythm to cycles. First comes optimism, then speculation, then distortion, and finally reversion to truth. The truth is always found in what's real. You can't print gold, replicate land, or duplicate a rare resource. You can't simulate trust built on tangible production. And while markets may temporarily misprice these assets, time always corrects perception. What's unfolding now is a quiet shift in global psychology. Investors, institutions, and even nations are beginning to rethink what security truly means. In a world where data can be manipulated and policies can be rewritten overnight, the pursuit of solidity becomes a form of rebellion, a return to grounding. Real things don't vanish when liquidity tightens, they rise in relevance. When you own something real, a resource, an innovation, an idea that solves a problem, you hold optionality in an uncertain world. Tangible assets don't just preserve value, they enable creation. They allow participation in the new economy rather than passive observation. And that's where wealth compounds, not in speculation, but in stewardship. It's not about nostalgia for the physical world. It's about recognizing the foundation that makes the digital possible. Every new technology still needs energy. Every network still needs hardware. Every breakthrough still requires something mined, built, or engineered. To own real things is to anchor yourself in that unchanging truth while still embracing innovation. The greatest misstep investors make in times of transformation is assuming that what's intangible will stay inflated forever. But the laws of value are immutable. Scarcity, utility, and necessity always reassert themselves. When speculation unwinds, those laws reclaim their dominance. We're moving into a cycle where owning real things won't just be wise, it will be essential. Energy, innovation, infrastructure, and productive technology will drive the next decade's growth. Those who align with tangible creation rather than synthetic leverage will not only endure volatility, they'll shape the new paradigm that follows it. So when the noise grows louder, when markets swing, headlines warn, and liquidity shifts, remember this: value never disappears, it just migrates, and it's migrating back to what's real. Real things are the foundation of progress, the collateral of innovation, the truth beneath the illusion. They outlast narratives, defy inflation, and transcend cycles. To own them is to own time itself, to hold a piece of what will still matter when the speculative dust settles. That's not fear, that's foresight. It's how long-term thinkers navigate transitions, not by chasing the ephemeral, but by anchoring in the tangible. Because in every revolution, industrial, digital, or financial, the winners are those who own the infrastructure beneath the dream. And that is the power of owning what's real. In every era of innovation, in every cycle of expansion and contraction, the same truth re-emerges: concentration builds wealth, but diversification preserves it. The future always feels predictable until it isn't. The world moves through phases of overconfidence, in markets, in currencies, in institutions. And then, suddenly, one unexpected event reveals how fragile that confidence really was. That's why diversification isn't just a financial principle, it's a survival mechanism in a world defined by disruption. We're living through one of the most transformative decades in modern history. Technology is rewriting the rules of productivity. Artificial intelligence is challenging human workflows. Monetary systems are shifting, geopolitics are realigning, and capital is moving faster than regulation can keep up. In such an environment, the illusion of safety in any single sector, currency, or strategy dissolves. The very systems we once considered stable are being tested, and that's exactly why diversification matters now more than ever. It's easy to fall in love with conviction, with the asset class that outperformed last year, or the company that became a symbol of innovation, or the currency that's long been seen as invincible. But history rewards balance over obsession. Every technological revolution has created new winners, and just as quickly, new blind spots. The investors who survive aren't those who predict every twist, but those who structure their portfolios to adapt when the world takes one. Diversification isn't about fear, it's about flexibility. It's the discipline to say, I don't know exactly what the future will look like, but I'm prepared for its possibilities. Innovation thrives on uncertainty. Markets punish rigidity. When we diversify, we acknowledge that even the most intelligent forecasts can be wrong, that systems evolve, and that resilience is built through optionality. Across sectors, this truth holds. Innovation in energy doesn't cancel out innovation in AI. Breakthroughs in genomics don't diminish breakthroughs in robotics. These aren't competing themes, they're converging ones. The future won't be built by one technology alone, but by the intersection of many. A portfolio that mirrors that intersection, diversified across the pillars of disruption, captures exponential growth while cushioning against volatility. Even beyond technology, diversification is protection against the concentration of policy risk. When monetary systems are stretched and governments intervene in markets, the value of diversification becomes self-evident. Holding a mix of assets, real, digital, productive, and scarce, ensures that no single event, decision, or institution can dictate your financial destiny. It's autonomy through balance. Think about what's happening globally. Supply chains are being restructured, energy independence is being redefined, and data is becoming a form of currency. Each shift creates both winners and losers. Those who place all their trust, all their capital, in one outcome are gambling. Those who diversify are positioning. The difference is mindset. One chases certainty, the other embraces change. True diversification isn't about owning hundreds of things, it's about owning the right mix of things, assets that behave differently when the world changes direction. It's about blending innovation with stability, growth with protection, tangible with digital. It's understanding that volatility isn't the enemy. fragility is. When I look at the future, I see exponential opportunity, but I also see interdependence, technologies converging, economies overlapping, risks multiplying faster than most can model. That complexity demands humility. It demands a strategy that doesn't just chase what's working today, but anticipates what might matter tomorrow. Diversification isn't a hedge against conviction. It's the framework that allows conviction to endure. Cycles will always exist. Markets will always swing. Narratives will always change. But the principles of sound strategy don't. The goal isn't to predict every outcome. It's to ensure that, whatever the outcome, you survive and thrive. When one door closes, when a market corrects, when a system breaks, when a paradigm shifts, diversification is what keeps the lights on. It's what allows investors, innovators, and nations to keep moving forward while others freeze in shock. In the end, diversification is more than financial architecture. It's a mindset of adaptability, an acknowledgement that progress is nonlinear and that resilience is built, not given. To protect what we build, we must respect uncertainty, because the next decade will be defined not by those who guessed right once, but by those who structured their vision to last through 1,000 different futures. Diversification doesn't dilute opportunity, it amplifies endurance. It ensures that when one path narrows, another expands. And in a world where change is the only constant, that endurance is the ultimate form of protection. Every generation believes its moment is unique, that its challenges, its markets, its crises are somehow different from the ones before. But history always whispers the same lesson: everything moves in cycles. Innovation, inflation, valuation, emotion, they all expand and contract in rhythm. The problem is most people forget they're living inside one until it turns. Thinking in long-term cycles isn't about predicting what comes next, it's about recognizing that progress is never linear, and that time is the most misunderstood variable in investing, innovation, and human behavior. Short-term thinking is seductive. The daily noise, the market reactions, the headlines, they feed a sense of urgency that blinds us to structural change. But the real wealth, the real breakthroughs, the real transformations happen across decades, not quarters. Patience isn't just a virtue in markets, it's an edge. Because the world consistently overestimates what can happen in 1 year and underestimates what can happen in 10. We are standing at the intersection of technological revolutions, demographic shifts, and monetary realignments, the kind that redefine entire eras. Artificial intelligence is not a short-term theme, it's a 50-year transformation. Energy transition is not a policy moment, it's a generational reconfiguration. Monetary shifts, from traditional currencies to digital networks, don't unfold in headlines, they unfold in epochs. Seeing these movements through the lens of long-term cycles allows us to interpret volatility not as chaos, but as calibration. Every cycle has its own psychology. In the early stages, innovation is dismissed. Then, as it gains traction, enthusiasm turns to euphoria. Eventually, euphoria invites excess, and the cycle resets. But for those who understand this rhythm, downturns become opportunities, not deterrents. When the crowd retreats, the long-term thinker advances quietly, building, accumulating, preparing for the next phase of expansion. That mindset separates reaction from conviction. Thinking long-term doesn't mean ignoring the short term. It means understanding its place in the bigger story. Market corrections, recessions, even crises. These are not endings, they're recalibrations. They shake out inefficiency and strengthen the next wave of growth. Innovation doesn't die in downturns. It consolidates, matures, and becomes inevitable. Some of the greatest companies, ideas, and wealth in history were born in the ashes of correction cycles. Those who think in years panic, those who think in decades position. We are conditioned to measure success by immediacy, quarterly returns, trending narratives, algorithmic popularity. But systems that endure are built with time as a core input. True progress compounds quietly. The early internet didn't change the world overnight. Neither did electricity, or the automobile, or the semiconductor. The same will be true for artificial intelligence, blockchain, and energy storage. These are the foundations of the next 50-year cycle, not just the next bull market. Cycles also apply to human behavior. Fear and greed oscillate just as reliably as prices. In times of abundance, people dismiss caution. In times of contraction, they dismiss optimism, but both extremes fade, and the world resets toward equilibrium. The long-term thinker doesn't anchor to emotion, they anchor to structure. They study how systems evolve, from scarcity to abundance, from disruption to integration, from volatility to stability, and they invest in the inevitability of progress, not the mood of the moment. Time rewards discipline and conviction. The innovators who see around corners are those who resist the noise and stay focused on the compounding nature of transformation. Every major advancement begins as an anomaly, survives skepticism, and then becomes the new normal. That journey takes patience, vision, and endurance. Cycles remind us that nothing is permanent, not booms, not busts, not dominance. Empires, companies, and currencies all rise and fall by the same rhythm. Understanding this isn't cynicism, it's clarity. Because when you know where you are in the cycle, you stop reacting and start preparing. You stop chasing what's already priced in and start building what's not yet recognized. The real advantage in any era belongs to those who can zoom out, who can look at the chaos of today and see the pattern of tomorrow. Long-term cycles show that technological revolutions always over-deliver in the end, even if they underperform in the short run. The compounding power of innovation, productivity, and adaptation always wins given enough time. So when volatility rises, when doubt spreads, when the world seems uncertain, remember that you're not witnessing an ending, but a turning. Every downturn has been the seedbed of the next expansion. Every correction has been the foundation of the next revolution. Thinking long-term means aligning with the rhythm of history rather than the pulse of panic. The future doesn't reward speed, it rewards endurance. It rewards those who understand that cycles are not obstacles. They are the very structure of progress. To think in long-term cycles is to see that time is not your enemy, it's your greatest ally. Because while others chase what's next, the long-term thinker quietly builds what lasts.